If you're a Canadian investor, you already know our market's superpower: dividends. While the US is the land of growth, Canada is the land of cash flow. We have the banks, the pipelines, and the utilities that pay you for just showing up. But you don't want to spend your weekends managing 50 different individual stocks, do you? You want a set it and forget it kind of solution that pumps cash into your account every month. Amazing. This is exactly where VDY comes in. It is the Vanguard FTSE Canadian High Dividend Yield Index ETF, and it has become the gold standard for Canadians looking to build a passive income stream. But with the VDY stock price hitting new levels this year, you might be asking, is it still a good buy? Or how does it stack up against its arch-rival, XEI? And exactly how much can you expect to get paid? So, these are great questions. Stick around because we're going to dive into the VDY holdings, the fees, and the dividend history, so you can decide if this ETF belongs to your TFSA, RRSP, FHSA, or any non-registered account. Let's get right into it. In an era of market volatility, there is something incredibly comforting about a monthly deposit, especially if you're just starting out. VDY is one of the most popular ETFs on the Toronto Stock Exchange because it simplifies the Canadian dream of dividend investing. By buying VDY, you're essentially hiring Vanguard to collect dividends or checks from Canada's most profitable companies, and after all that, bundle them into one convenient package that you get at the end of the month. It's a bet on the stability of the Canadian economy, focusing on the giants that have been paying dividends for decades. But what is VDY? VDY is an exchange-traded fund, ETF, that tracks the FTSE Canada High Dividend Yield Index. Unlike some other funds that just look at any dividend-paying companies, VDY specifically targets common stocks that come with high dividend yields. When you look at the VDY stock profile, you'll see it focuses heavily on the big three of the Canadian economy, which are the financials, the big banks like RBC and TD, the energy companies like pipeline giants Enbridge and TC Energy, and lastly, the telecoms, which are TELUS, Rogers, and Bell. It is a market cap weight fund, meaning that the bigger the company, the larger the slice it takes up in the ETF. Now let's look at how it compares to other ETFs. If you've searched for dividend ETFs, you've likely seen the XEI versus VDY debate. XEI is a BlackRock's iShares version of a high-yield Canadian fund. They are very similar, but there are two key differences. Number one is sector concentration. Look, VDY is much heavier on banks. And if you believe the Canadian financial sector is invincible, VDY is absolutely amazing. XEI is slightly more balanced across other sectors, like materials, utilities, and so on. And number two, the holdings. Look, VDY holdings typically consist of about 50 to 60 stocks, and XEI usually holds closer to 75. But both have a very low management expense ratio of around 0.22%. That means that for every $10,000 you invest, you're only paying about $22 a year in fees. It's a small fraction of what a bank mutual fund would charge you, which can be 2 to 3%. But okay, I know what you want to hear about the dividends. Let's look at that. This is the reason we're all here. Does VDY pay monthly dividends? Yes, it does. Unlike many US ETFs that pay quarterly, VDY actually happens to pay its investors every single month. Historically, the yield hovers between 3.5 and 4.5%, though it fluctuates based on the VDY price. If you look at the VDY dividend history, you'll see that while the monthly amount can slightly vary based on the underlying company's payout, the trend has been one of long-term stability. For those wondering when is the VDY dividend paid, the ex-dividend date usually falls near the end of the month, with the cash hitting your account somewhere around the first week of the following month. Now let's look at an example to kind of better understand this whole dividend situation. So let's look at why VDY stock price matters less than the number of shares you own. So look, imagine you have a portfolio of $100,000 in VDY. At 4% yield, that's $4,000 a year in passive income, or roughly $333 every month. And if you set up a DRIP, which is the dividend reinvestment plan, you aren't just pocketing that cash. You're using that money to buy more shares of VDY every month without paying a commission fees. Over a decade, that creates a snowball effect. That's what everyone is talking about. You own more shares, which pay more dividends, which buy even more shares. And it just keeps going. And this is how many Canadians plan to retire without ever touching their principal investment. Is VDY a good ETF for you? It's the ideal choice if if you want monthly income rather than waiting every 3 months for quarterly payouts. You're bullish on Canadian banks and energy. You want a low-cost, hands-off way to own the best of Toronto Stock Exchange. If you're looking for global growth or high-tech exposure, VDY unfortunately isn't the place. It's a strictly Canadian income play. But as a foundation for a sleep well at night portfolio, it's very hard to beat, trust me. So VDY isn't just a stock. It's a diversified basket of Canada's most reliable cash companies. Whether you're a retiree looking for income or a young investor building a dividend snowball, VDY offers a low-cost, high-liquidity way to capture the best yields the TSX offers. Anyways, guys, thank you for watching. If this breakdown of VDY and VDY versus XCI helped you and you're planning to add VDY to your watch list or portfolio, let me know by hitting that like button. Do you have any questions about the specific VDY dividend or any other Canadian ETFs? Drop a comment down below. I love hearing you guys are building your portfolios. It's always nice to hear. I'm not a financial advisor, by the way. Investing always involves risk, and always do your own research and due diligence before putting your hard-earned cash to work. Everything I do here is for entertainment purposes only, and this is my personal advice, not a financial advice. Anyways, thank you so much for watching, and I'll see you in the next one. Take care.